I just closed my FCX position for $1,080 in profit, but reality is I almost blew it. I did not roll out my short calls fast enough, and I watched them get so deep in the money that liquidity just evaporated. This is week 2 of trading a $50,000 option account, and today I'm going to show you exactly what I did wrong, how I'm going to fix it going forward, and why I'm managing gamma on the short calls much faster. Plus, I exited completely my GME covered strangle position due to the fundamentals not matching my expectation, and I have a new bearish position on HIMS. So let's deep dive into it. So welcome back for week 2 of engineering options. I'm documenting my trading journey, trading systematically with a $50,000 account. As of this week, I have 12 open positions, 6 strangles, 3 short puts, and 3 directional diagonals. My account from last week is down about $750, even though I was able to take the profit in FCX. But this is just normal fluctuations on a week-to-week basis due to the open positions profit and loss. Compared with beginning of the year, we are still up significantly, so things are still going well. My buying power utilization is slightly low, below my target usually of around 50%, but that's on purpose due to the fact that the VIX is still low and earnings season have just started, so I'm not looking to get a lot of positions out right now, and I cannot find great opportunities. About this week, SPY had a pretty mild week. You can see here that barely anything happened. Most of the days were red closes, but it's hovering around all-time highs. If you look at the volatility at the VIX, it has in a slight uptrend. It has upticked a little bit from below 15. Now it's hovering around 16. What is normal due to the fact that we are coming into the earnings season with big earnings like Netflix coming out next week. Regarding the first week of earnings season, Goldman Sachs and BlackRock did pretty well on the financial sides, but there were disappointments from JP Morgan and Bank of America. So totally a mixed bag, no clear trend. So we are in this unclear environment of where to go from here. So the first position I want to talk about is my GME position. I took a full exit on GME for a couple reasons. This type of position where I'm selling a covered strangle, or in other words, it means buying shares and selling a put and a call that I roll out. The reason I'm exiting this position is because IV, the white line, is now below the actual realized volatility. So with implied volatility just trending down, IV percentile is at 0%. The premium I'm getting per day now is only about $3 in Theta. When I opened this position about a month and a half ago, 2 months ago, I was getting about $6 per day in Theta. So the fact that IV has come down, is trading below realized volatility, at the same time, the stock is not going higher. So I have two theses usually for this type of covered strangle positions. One of them is the drift higher of the stock, so to get that profit ticking in from the stock slowly drifting higher, and the other one is that IV surpasses realized volatility and I can collect the variance risk premium. In this case, there's neither, so it is time to focus somewhere else. In about 2 months, this position still netted me about $250, what is quite decent, but I'm focusing my capital elsewhere at this stage. Next positions I want to talk about is Bank of America and LW, Lumpton West. So these are two positions that I was stopped out. First, on the Bank of America side, I actually should have closed this position before earnings. My stop was not hit before earnings, but going into earnings with such this type of short-term ratio call diagonal is always a risk. This risk did not pay off, earnings were disappointing, and the stock collapsed a little bit, putting me in a net loss of $450 in this position. Going forward, I will try to close before earnings to avoid this type of situations. Lumpton West was more a natural type of stop loss that was hit. I entered after this big drop, thinking that we'll have a continuation to the downside after disappointing earnings. The reality is that the stock stabilized and then rallied up a little bit, my stop was hit, so I just took the loss. It was not a very significant one. I lost $152 in this one. Last one that I also closed is LCID. I also had a bearish ratio put diagonal. Reality there is just that my long put was less than 45 days to expiration. At that time, Theta really starts to pick up. I did not want to keep that position open, so I took my win in that case for $204. I closed out these ratio diagonals I had, 2 bearish and 1 bullish. Alright, the big one that I want to deep dive into today is FCX ratio call diagonal. I already spoke about this one last week. My goal was to roll out and up my short calls to unlock some more profits. The problem is that, as you can see in the chart, the stock rallied hard on Monday and again on Tuesday. When it did that, my short calls that were expiring Friday were so deep in the money and the delta started to get so high that it was very hard to find liquidity to roll it out. And I was still able to manage to roll one of the calls out, netting $4 in credit to the 57s on February 6th, but I was not able to get matched on the other one. And then the next day on Tuesday, they just kept rallying. When the market opened, it was even higher, trading above $60, and I just had to close my position. The reality is that the short calls start with a small delta. I sell them at about 30 delta. But when the stock rallies hard, they have a really high gamma. You can think of it as the option needs to trend to 1 or 100 delta by expiration. So by every move in delta, or even the passage of time, the variation that you get in delta is very high. So the stock moves up a dollar, but your delta on the short call might move up 10, 20, 30 deltas. The closer it gets to expiration, the faster that rate of change. That rate of change is called gamma. So I end up in a gamma problematic situation in which my long calls are getting much less delta compared with my short calls, and at a certain point my short calls just surpass the delta of the longs and I start to be delta negative, and that is a problem. So at that moment I just closed the whole position, I bought back my short calls, and I made a total profit of $1,080. Still, this is slightly disappointing because if I had rolled my short calls the week before, I would be able to unlock more profit. So this is actually a small loss compared with what I showed last week because I didn't roll my short calls aggressively enough. Alright, last one that I want to deep dive into today, it's HIMS. HIMS I entered in a bearish put diagonal. I bought a 140 put for April and I sold a 29.5 for January 23rd. That's expiring next Friday. The net cost was about $1,000. And you might see here that I'm only buying one long put and selling one short call. Why am I doing this? Well, the reality is that HIMS options are just expensive. You can see $1,000 net cost per each set of options. And I did not want to get too much exposure in a directional position at this stage. I felt that I already had enough exposure out, so I went only for 1-to-1. And this is the reality of trading a small options account, that you need to be selective and to make choices. So ideally, I like to keep them at a ratio so that I can uncap my profit potential, but the reality does not always match what I would prefer. And so the reality is that I ended up opening this position. I still like it because it allows me to collect some Theta, about $3 per day. I feel like it is a balanced position. We can see here from my profit potential, if the stock rallies up, my stop loss is at about 34 and a half. At 34 and a half, I'll have about $150 loss. But if the stock keeps falling or just keeps stable, I can roll out my short puts, I can keep collecting credit, and if it rallies really hard to the downside, well, if it passes below the 27 and a half, I'll have to look to close, because you can see here that my profit is max at about $29 to $28. If I'm not able to roll that short put, I have to close, because then any further movement down takes away from that profit. I get in a situation similar to the FCX, where I'm starting to be eaten by the gamma. Okay, so now what are my open positions? Well, on the volatility side, it is mostly the same as it was last week. I have EQT, SLV, UNG, and JOBY that are the same positions. Plenty underwater, it just kept rallying higher and higher. It seems now to be finally stabilizing over the last couple days. I still have a little bit of margin in this position at this stage, so I'm not immediately looking to close. However, I'm also not looking to roll my short put, because the situation when this rallies so hard, so fast, is that it can equally rally down. So I do not want to end up holding almost a straddle at a very high price. And in these precious materials, it can rally really hard, really fast. You can see same situation here, rallying from 36 to 49. And then it's very common to have a rally back down to a price that it finds the equilibrium. So I'm just going to hold this position for the moment. If this position hits about $900 in loss, I will close it out. That's my stop loss. It's about 3 times the credit received. UNG is keeping in a very similar situation as it was last week. Still no changes here. I opened JD and USO. I discussed that in detail in last week's video. For now, they are just new positions. They are on track. Almost no difference. On the strategy notes, I feel that I'm fully allocated on the Strangles. I have a little bit of margin if an opportunity appears after earnings, but for the moment I'm just keeping track and I'm just looking what happens into next week. On the semi-directional side, I opened 3 new positions. So I have EOSE, NU, and FXI. They're all new positions. They give me a good amount of credit, about $300 in credit overall. I'm happy with these positions. They all match the requirements I have. That is, the implied volatility is surpassing what has been the realized volatility, and at the same time that the stocks are moving up. All of them, all of these products have been moving up. We can have a quick look here. We can see that EOSE has been on a good move up trend. Overall, the trend is up. I'm looking at a stop around the $12 mark. NU also has been moving up. It's now in a channel, a consolidation channel. My stop here is about $14.5 to $15. And lastly, FXI, you can also see that has been in a good consolidation channel. The long-term trend is up. So I like this type of positions where you have a long-term trend that is bullish, but they are consolidating. Volatility is not so high, but implied volatility is still paying well. I like these positions for my short puts. On my directional positions, I have just 2 bullish positions at this stage, NU and EEM. So they are positions that I've been having from last week. I just made small adjustment in EEM, rolling out the short call. I got some credit from it and I unlocked a little bit of profit by rolling up. On the bearish side, I already mentioned the HIMS position, just open. So for the moment, I'm not looking to do anything, but sometime next week I will have to roll out both the EEM short call and the short put in HIMS. If the strikes start being breached, then of course I will look to manage to avoid having again the gamma problem mentioned in FCX. Regarding my account, so something I like to look at is the risk matrix in interactive brokers. So this is a what if situation and it does several simulations, and you can see what would happen if the SPY drops X%. So here on the X-axis, you have the movement of SPY. So I like to look at -10% and -20%. If the SPY were to drop 10%, you can see that I would be at a loss of about $7,000. If the SPY were to drop 20%, I would be at a loss of about $15,000. This matches well my portfolio expectations. I try to not have more than 20% loss in SPY, giving me more than a 30% loss in my portfolio. A 30% loss in my portfolio is about $16,000. So this is matching my current expectations. All right, so that's it for week 2. I closed 4 positions, time based, and stops that were hit. I opened several new positions. I opened 3 short puts. I opened the HIMS diagonal. I made a good profit on FCX, but I learned that I need to manage better the gamma. Account is slightly down this week, but we are still more than 5% up on the total of the year. So my main takeaway from this week is really I need to be better at managing the short calls before they get too deep in the money and I get overrun by the gamma. So follow along and subscribe also to my Substack. I will do this every Sunday at least for 12 months. So like and subscribe and let me know in the comments what are you trading this week. I would like also to hear from you guys. Any interesting setups you have, any positions you are looking into. I respond to everyone that puts a comment down below. See you next Sunday. Thank you.